What's up, everybody? I'm Leif with Adaptable Wealth, and in today's video I'm going to give you 3 asymmetric investments that can help drive significant gains in your portfolio with minimal risk. Ready? Let's kick it off. First, we need to understand what an asymmetric investment is. Let's imagine that it's 2009 and one of your buddies tells you about Bitcoin. It's 10 cents per coin and he thinks you should buy some. Just $100 or even as little as 50 or 25 bucks. Knowing what we know now, we'd not only want to bet every financial asset we have, we'd toss in the kids, the wife, and the dog. But even if we went back to 2009 and had zero clue about how well it will end up doing, we'd still want to bet that $100. Why? Because it's what's called a positively asymmetrical bet or investment. This is any investment where the potential gain is larger than what can be lost. In our Bitcoin example, it was reasonably likely to expect the price would go up to 20 cents or even jump up to $1. That's a 10x return. In other words, the most you could lose would be $100 or 100% of your investment. But the potential of a doubling or even a 10-bagger heavily outweighs the 100% loss potential. Monish Pabrai describes it as a heads I win, tails I don't lose much situation. When most people discuss asymmetric investments, they stop right there. They simply look for a reward versus risk ratio of at least 2 to 1 and argue that if an investment can double your money or better, then it qualifies as an asymmetric investment. But if you really think about it, the potential for doubling is true for any investment. So that way of thinking about it ain't gonna cut it. There must be other constraints to qualify as an asymmetric investment that you actually want to take. We already mentioned a return versus risk ratio of at least 2 to 1, but an asymmetric investment must also have a time constraint, a low required hit rate, a catalyst, and most importantly, it doesn't require a substantial percentage of your financial wealth to have a meaningful impact on your portfolio. There must be a time constraint, because what good does it do if your investment takes 25 years to double? That would be a horrible investment. The S&P 500 has returned an 8% CAGR over the last 100 years. That means you have a pretty good probability of doubling your money every 9 to 10 years if you just stick your money into an S&P 500 index fund. If you can't at least beat that with similar levels of risk, then that investment is no longer worth your money. It may technically still be considered an asymmetric bet, but when compared to the alternative uses of your money, it is no longer a desirable investment. The hit rate is the percentage of time that you achieve your desired ROI. The hit rate is essentially the probability of success. It's dependent on the distribution of returns for that investment. The more positively skewed the potential returns are, the more likely it is that you will achieve your desired outcome. Billionaire fund manager Paul Tudor Jones proclaimed in an interview that he shoots for a reward to risk ratio of 5 to 1. So for every dollar he risks, he aims to make 5. By finding heavily skewed return distributions and shooting for significant gains, Jones needs a 20% hit rate just to break even. A catalyst is some future event that will cause your investment to more than double. And finally, the upfront investment should be small enough that if you lose 100%, your portfolio is not destroyed and you don't put yourself in financial peril. Now that we understand the gist of what an asymmetric investment is, let's take a look at 3 investments that you can make right now that meet the criteria that I just outlined. First, we have highly shorted stocks, and I'm going to use GameStop, ticker GME, as the example here. Let me start off by saying GameStop as a company is horrible. Revenues are declining, it's highly unprofitable with negative operating margins and return on invested capital, and it has generated negative cash flows in 3 of the last 5 years. So, why do I claim that this is an asymmetric investment? Because of this. 11% of shares outstanding, or 40 million shares, are currently being shorted. To put this into perspective, the median short interest of the S&P 500 runs in the 1.5% to 2% range, while small and mid caps run in the 3 to 4% range. And highly volatile stocks like AMD, Tesla, and industrial logistics came in around 3%. Because of the way the shorting works, those who have a short position on a stock are theoretically exposed to unlimited losses. And if the stock starts rising, losses start piling up, which forces them to cover their shorts to limit their losses. They cover their short positions by buying back the shares, which puts even more upward pressure on the stock price, leading to what's called a short squeeze. If we take a look at the GameStop chart, you can see 6 instances in the past 4 years where the stock popped, generating getting more than 200% returns. And in 3 of those cases, it popped 2,300%, 750%, and 550%. Simply having $1,000 invested in GME generated $23,000, $7,500, and $5,500 in profit. This is the essence of an asymmetric investment. You only risk $1,000 or whatever you can comfortably afford to lose, and it can add several multiples of that in profits to quickly grow your financial wealth. In case you're interested, MarketWatch maintains a list of the most shorted stocks in the market. I left the link in the description below. Just remember, these are highly speculative stocks, and there's a chance that you lose your entire investment. These stocks are heavily shorted for a reason. They're most likely shitty companies that are on their way to bankruptcy, and the big institutional investors want to make some money on their demise, so they're shorting the shit out of them. If you're enjoying this video and feel like you're getting some value out of this content, I'd appreciate it if you took a second to hit that like and subscribe button. It's an easy and free way you can support this channel and help me continue bringing you this type of analysis that helps you construct and grow your portfolio. Okay, let's get to the next asymmetric investment. Next, we have Bitcoin. Bitcoin has matured since its inauguration in 2009, and although 100,000% returns are no longer possible with this asset, the potential for a 3, 4, or 5x absolutely still remains. When you combine a fixed supply with increasing adoption in some of the world's largest financial institutions, you get the potential for significant price appreciation. And although I have my doubts that the supply will remain fixed forever or that it will ever become a currency, I can confidently say that once the Bitcoin ETFs make their way into 401ks, pension plans, and corporate balance sheets, it's over. Supply-demand dynamics practically guarantee that Bitcoin reaches 250K per coin and possibly more. And if you're not satisfied with those peasant-like returns, you could buy shares of MicroStrategy, ticker MSTR, which has been borrowing millions of dollars to buy and hold Bitcoin on their balance sheet. In other words, it's a leveraged version of Bitcoin. And check this out. They're being shorted to an even larger extent than GameStop, with 14% of shares outstanding being shorted. Talk about the ultimate asymmetric investment. The final asymmetric investment is the buying of options. We're going to use MicroStrategy, ticker MSTR, as an example again. It's currently trading at about $135 per share. Here are the options chains for MSTR. At 135.5 strike price, I'd have to pay $685 to control $13,500 in value. What happens if the stock increases by $10 per share up to $145? If you bought the shares outright, then your position would be worth $14,500 for a net profit of $1,000. This is a little less than an 8% gain. But let's not forget, by purchasing a call option, you only had to invest $685. That $1,000 increase in the value of your holdings translates to a $315 net profit because you have to deduct the $685 that you paid for the options contract. The ROI works out to be 46% versus the 7% you'd get if you bought the shares outright. The real asymmetry with options comes in as the price of the underlying security continues to increase. Instead of a 7% increase in the price of MSTR, let's take a look at a 20% increase, or $27 per share. If you bought the shares outright, then your position would be worth $16,200 for a net profit of $2,700. With our call option, you still only had to invest the $685. Deducting that premium from the $2,700 increase in value of your holdings works out to be a $2,015 net profit, which translates to a 294% ROI. It looks like this in graphical form. The beauty is your maximum loss potential is limited to only the premium you paid to purchase the contract, regardless of what happens to the price of the underlying stock. Remember, one of the most important qualities of an asymmetric investment is that the potential loss is limited and affordable for you, all while offering the potential for a 3, 4, 500% return or more. In this video, we only talked about buying options and not selling options, and although selling options does offer a levered return, they do not qualify as asymmetric opportunities. This is because when you sell a put option, your gain is limited to the premium that you collect. On the other hand, when you sell a call option, you're exposed to unlimited losses because the price of a stock theoretically has no limit. If we take a look at our requirements for an asymmetric investment, it's clear that neither of those cases meet the requirements. So, to summarize all of this, the goal is to make small yet highly improbable investments that could lead to disproportionately large gains. The key is to sprinkle a few of these high risk-reward investments on top of a portfolio with a solid foundation of high-quality stocks, bonds, and real estate. It can significantly improve the risk-return profile of your portfolio. And one last reminder, Only bet what you can afford to lose. And don't get loco and use margin or debt for these types of bets. Be happy with doubling or 3, 4, 5xing your money. Debt increases the risk so much that it's just not worth it in my opinion. I hope you enjoyed this video. If you did, please like and subscribe so you don't miss any videos when I release them. It's a quick and free way you can help me grow this channel if you find this content valuable. We'll see you on the next one.